This episode is brought to you by 10 East. Longtime listeners know I've invested in private markets quite a bit myself, but with access to these markets broadening, it can be hard to know where to find vetted, high-quality offerings. That's where 10 East comes in. 10 East is a platform where qualified investors can co-invest on a deal-by-deal basis across private equity, private credit, real estate, venture, and other one-off opportunities typically unavailable through traditional channels. They're founded and led by Michael LaFell, who spent his early career building Davidson Kempner and who invest material personal capital in every offering they bring to the platform, aligning interests with 10 East members who co-invest at their discretion. Join numerous founders, executives, and portfolio managers from leading investment firms who use 10 East to diversify their personal portfolios. Inquire for membership at 10east.co. That's the number 10east.co. Welcome back, everybody. We got an awesome episode today. Our guest today is Brendan Ahern. Brendan is the Chief Investment Officer at KraneShares, which provides investors access to China, climate, and other uncorrelated strategies. He produces a daily update called China Last Night, a daily note recapping important news out of China. China's a hot topic lately. Chinese stocks have been struggling. It's an opportunity or what? So we're going to go into what's really going on there with one of the most knowledgeable people on China. Brendan, welcome to the show.
Hey, great to be here. Thanks for the opportunity, Meb.
So what did you say last night? What was in the update? What's going on?
Well, we're at the tail end of the earnings season for the Chinese internet company. So today we had Pinduoduo, which many people know for Temu, absolutely smashing analyst expectations. I don't think I've ever seen a company report adjusted net income and adjusted earnings per share that was twice the analyst estimate. So just tremendous growth there. And as well as we had a online video company called Kuashu also beat on the big three analyst expectations in terms of revenue, adjusted net income, adjusted earnings per share growth. And then we had a smaller player called VipShop.com, which is a smaller e-commerce player, also report this morning. So it was an early start to get China Last Night out the door at a reasonable hour.
A lot going on. I've actually never been. I'm not including Hong Kong free turnover. When was the last time you've been over there?
So I was in China, I was in Hong Kong, and then took the train up to Shenzhen in December of last year. And then I'm going back in just a few weeks.
Cool. Well, one of these days I'm going to hit you up and you can be the travel consultant or I'll tag along with some of your goings-ons. But let's start at the high level. What's the big picture view today? And then we can go down all sorts of nooks and crannies.
I always start, with a bigger picture issue, which I know, Meb, you've spoken about, which is over the last 15 years since the global financial crisis, U.S. stocks have outperformed non-U.S. equities just by an incredible margin. That, the S&P from that March 2009 low is up over 950%. And a lot of people will say, well, MSCI China is only up 161. And that's because you have American exceptionalism versus communist authoritarian regime about to roll into Taiwan. But the point of China Last Night and just our research at KraneShares is we're finance people. We should be data driven. And that argument does not hold water. One, in that non-U.S. equities, all country world ex-U.S. is not even up 1/3. China, yes, underperformed, but EM is not even up 250. Chile, which I would argue is the most economically stable country in South America, as well as the most stable politically, it's up a resounding 68% over the last 15 years. So something's going on, and that something is the factor dysfunction of some of these non-U.S. markets versus the U.S. I would argue the U.S. market is more of like a growth factor, whereas a lot of these non-U.S. markets like EM, like China, like a Chile, historically, they were very, very overweight energy and financials. In the case of MSCI emerging markets, MSCI China, you had those two sectors were 50% of the benchmark. And then you throw in other value sectors, industrials, materials, real estate. It's a value factor. And to prove that, you'd say, well, what is a growth sector within EM and China. And how did that do over this time period? And EM tech actually beats the S&P 500 over the last 15 years, but it was only 10% of the benchmark. It had no effect. In the case of China tech, it went up over 1,800%. It actually went almost double the S&P 500, but it was literally 2% of the benchmark. So a lot of our minds think about China. We come up with these easy solutions. It's kind of like a Danny Kahneman system one error, but there's something more to it.
China, for better or worse, is always the poster child for emerging markets, I think, and you can tell me better, maybe a quarter or a third of the market cap indices now, at one point closer to probably 50. And so still the dominant country and contributor. What's it look like as far as economy? What's it look like as far as the vibe? I feel like the number one concern in the word cloud currently is real estate, but you got a little more in touch with that than I do. So let's hear it.
Yeah, I thought being in Hong Kong and Shenzhen in December, in your head, you'd be like, China's economy is doing terrible, buildings on fire. And life was no different than downtown LA or walking down Park Avenue here in New York. Streets were crowded, traffic was terrible as usual, restaurants were crowded, going to malls in both Hong Kong and Shenzhen, they were crowded. There's a hustle and bustle. And I think that's almost what's hurt a lot of investors is that visually life is normal. But you look at the markets and you're like, they're in a Great Depression. Like, how can there be this observational disparity? And I think part of that is that, to your point, 60 quarters of hanging on to asset allocation, people give up. And that's not just true here in the US, but it's also true globally. And I think a lot of money has come out of non-US equities, including Asia money, including China money, out of what hasn't worked into the one thing that has worked. I mean, maybe India and Japan are regional or small overweights, but I think a lot of money's come out of the space. And the evidence of this unwind in China would be the disaster that January was this year, when the local Hong Kong, as well as the mainland market, the Shanghai and Shenzhen stock markets, really went through a derivative-induced meltdown. And when you have this liquidation event, markets go down on an elevator because there's no one to take the other side. Everyone is out of China because everyone who had been in China buying the dip, you got blown out. You took on more and more losses, so you finally capitulate. And that's been our thesis is we've had this downdraft in January and markets have rebounded really, really strongly. Shanghai, Shenzhen, Hong Kong, several of our ETFs are outperforming the S&P and NASDAQ 100 by 20, 30%. But no one even knows or cares because they're all out of the trade. And the question, to your point then, is like, well, is this a dead cat bounce or can the rally actually sustain itself? And that's where we do think there's some positives that have been happening in the background that maybe we notice because we're down this China wormhole. Everyone else has vacated the premises and things have changed for the better. I just don't think people have really kind of recognized it.
I'm personally attracted to when listeners are probably long sick of hearing me say this, but favorite investment, cheap, hated, and starting an uptrend. And China, to me, is checking all those boxes. So when I hear things like people talking about not just China, this applies to, I think, a lot of foreign markets where, hey, this market, and listeners, you can pull up total return charts of many countries and they have zero returns for 10, 15, 20 years. And that's nominal, not even real, right? So I like to hear that. That's a positive to me as opposed to the opposite from a value perspective. And so China, certainly the stock market is at these valuation lows that it keeps touching a few times over the years. But what do we think about, like, the main concern, I feel like, and correct me, is it real estate and property right now? Is that what's on most people's mind that are interested in or invested in China?
I think real estate is a real issue. I think that's not because there's the belief that it'll become China's Lehman moment, which is kind of a standard Western media narrative. In China, no one believes that. That the belief is that why would the Chinese government allow a financial crisis to occur? That the greatest error by a central banker, the view in China is the US Federal Reserve for allowing Lehman to go bankrupt and actually creating a crisis, which created regime change politically. That, the Republicans lost the White House. So there's less concern about the financial crisis of Evergrande going tapioca. It's more of real estate as prices have fallen. It's really weighed on domestic consumption that similar to photos of down in Manhattan Beach, where 50 years ago it was farmland. I grew up with my mom is from Denver, and Stapleton Airport Denver was a cow town. And you drive up to Boulder to see a CU game, see a Buffs game, and it was farmland between Denver and Boulder now. So that is China in a microcosm. Real estate has been a one-way trade. Everyone made money. And for the first time in their adult life, it went down. So that's weighing on domestic consumption. It's also weighing on the real economy because lower real estate prices means less demand for new apartments, which means less construction workers, plumbers, electricians, less new home furnishings. So real estate is actually affecting the real economy. They've benefited from demand for export-driven manufacturing, but there's a push from the government to get real estate going. And you're starting to see some of the nudging. It's the amplification of that policy on real estate is becoming very, very real to get those real estate prices back up, to try to get domestic consumption going again. I think that's one area where people haven't really noticed. I mean, to me, it's interesting. In the Q1, China's GDP was 5.2%, which is a pretty good number, second largest economy in the world. The value of that growth is very, very large. But not one of the 21 economists who submit an estimate into Bloomberg was that high. And to me, it just showed that even these Chinese economists are really pessimists, and things are actually improving in China. And actually, that's showing up. We studied it obviously in Q4 of last year, but the Q1 earnings, they're actually beating estimates, which again goes back to there's something fundamentally improving in China. So besides real estate, I would say geopolitical is the other one.
By the way, listeners, this probably more than any other episode, we have some fantastic PDFs in research, both from KraneShares and then a couple other big macro shops like Bridgewater and Fidelity and KKR. KKR kind of has a sneaky good macro department, and they put out a really great piece on China.
Yeah, Henry McKay is someone I've followed for a long time.
And so they had some nice charts, one of which was talking about China in the US, but it was saying, China also, a big part of the story has been an increase in partnerships and exports within Asia to a lot of the other economies that are growing kind of around China. Are you guys seeing that? Is that something that is a part of this story where maybe they're less dependent on just exporting to the US and it's becoming more of a global and even regional play too?
Yeah, I think what we saw as a supply chain problem during COVID, things you wanted, your new Peloton bike, or it was stuck up in the port of LA, or they couldn't get the bike from the factory in China to the port in China. But from a China perspective, that is a revenue problem for Chinese corporations. For them, if they can't get their goods to their customers, they cannot make money. And the China Plus One strategy is being led by Chinese companies. That Chinese manufacturers are saying, because we have these factories that have solely been in China, we need to put them in Vietnam, Malaysia, Indonesia. And that way they can diversify their output. So if something happens in China, they keep the lights on. So it's a kind of an interesting view in China about what we deem a supply chain problem. It's their revenue problem. And yes, they're definitely selling more within Southeast Asia. Certainly the commodity geared countries. If you go to the Middle East, China's the number one buyer. So other parts of the world, the views of China are much more balanced, I think, than we have a very constant negative media narrative. And some of that is driven by the political situation where who had a better trip to China, Anthony Blinken or Elon Musk? I've kind of jokingly felt like diplomats from both countries should be forced to bring a successful business person, because a lot of people who'd say maybe to you, Matt, like, oh, we wouldn't touch China, but you're implied China through great US multinationals like Apple and Tesla and Boeing and ExxonMobil, Caterpillar. You're benefiting from China through US multinationals. You're highly exposed to China, which is why we all should be pushing the diplomats to do a better job to get along with one another. And it certainly takes two to tango. I'm not pointing the finger at one side. I think they both could do a much better job.
I imagine you get tired of this question, but I feel like every possible RIA, certainly retail investor, institutional investor, cannot talk about allocating to China without bringing up geopolitics in Taiwan. I can't imagine you've had a conversation on China in the last 2 years and that not come up. Maybe it has, but give us what's y'all's position, what's y'all's thoughts. Something going to go down, something going to go down at some point, something going to go down. It's not going to matter. What do you think?
I was in Taiwan last summer for work. And when we bring you the China map, we will not do it over the summer because Taiwan, like lots of parts of China, was incredibly hot in August when I went. But the view in Taiwan, and there are two political parties. One leans kind of pro-China, one anti-China. And the view is Taiwan is highly intertwined economically with China, just as it's intertwined to the US. And the view, my sense from talking to, these are professional investors, was just leave us alone. They were like, please don't send any more US diplomats over here to do a photo op and then leave. One of the investors I met with said, there's 200,000 Taiwanese live in Shanghai alone. Foxconn, that makes the iPhone, is actually a Taiwanese company operating in China. And the view is like, listen, there is a lot of history. And it means going back to the Opium Wars, and Taiwan was part of China until Japan invaded in 1900. This is events that led to World War II. And so they're like, it's complicated. It is a complicated issue. So let's just leave it alone. Let's just get along. Don't stir the pot. And I think all we would say to investors is there's a thing called Kinmen County. Most of the big island where Taipei city sits is 100 miles away. Kinmen County is part of Taiwan that sits 3 miles off of the coast of China. And if you use Google Maps, you can do it where you can see like people live there. There's schools. You can see the high school running track. And I would just say, if you thought they were about to roll in, the last place in the world you would want to live is Kinmen County. And the fact that thousands and thousands of people live there gives you what the locals think of that probability. Ultimately, China's economy is so geared to the West that without the West, China would collapse. Without oil and LNG from the Middle East getting to China, they would starve from a commodity. Thankfully, China needs the West just as the West needs China. And a lot of idealism has been snuffed out of me as being part of an entrepreneurial venture. Just happened to be in finance, being part of KraneShares, starting at zero. But I do think Thunderbird University has the great saying, countries that do trade with one another don't do border guards. And thankfully, the US and China are very, very intertwined. And I'm not a believer in decoupling.
I wonder how much of the narrative around China post Russia, Ukraine was really about that, where to me, Russia, really a rounding error when it comes to market cap. China, not for not just EM indices, but also global indices. And so I think, do you ever hear professional, institutional hesitancy because of the Russia thing where they're like, look, I like China, I just don't want my securities to get frozen, put on sort of Han Solo carbonite for a while? Or is it something that people are actually not as concerned about? Maybe they're concerned about something more so. What tends to be the main, if there is a main, is that one of them concerns?
Yeah. I think it is a concern. And it's easy to say, listen, equity risk premium compensates you for that. But the end reality is, if that is your concern, then your sell list is US equities. Because of this revenue exposure to China, Tesla, Apple, Qualcomm, NVIDIA, Texas Instruments, Boeing, Caterpillar, Johnson Controls, ExxonMobil. I've had people say like, they're going to roll into Taiwan, so we're overweight Japan. I'm like, explain to me how's that's not a regional event? And it's why, I think investors in the business community should be proactive in trying to mend a relationship that, unfortunately, during COVID went through a bit of a COVID divorce. There were COVID babies, but there were COVID divorces, unfortunately. And diplomatically, we've gone through that. And unfortunately, business people are getting along just great. Tim Cook back in China. Elon Musk was just there again.
Tell me a little bit about KWEB. So that's y'all's largest fund. It's over a decade old, I believe. Is that correct? 10-year anniversary?
Yeah.
Tell us a little bit about that fund.
Yeah, our founder, John Crane, lived in China beginning in 2001. And really the thesis for building KraneShares, a China-focused ETF provider, and to your point, we've gotten into carbon credit allowance, futures trading, but he saw how China's economy was evolving away from being solely dependent upon export-driven manufacturing, and then saw the rise of domestic consumption as these Chinese cities, people moved out of the rural areas looking for jobs and a higher standard of living. They were getting educated and spending more money. And he saw how traditional Chinese indices and like broader EM was basically financials and energy companies. And when I had met John and he articulated his vision, I was like, you're right. People say Chinese equity market is not a good transmitter of GDP growth. And yeah, because banks and energy stocks don't really grow that fast. And so the whole point of KWEB was give you exposure to these growth stocks. And John told me, he's like, this company called Alibaba, this is back in 2012, 23. He's like, this company called Alibaba is going to go public. And I'd never even heard of Jack Ma. And we built KWEB anticipating Alibaba going public. We listed 13 months before Alibaba went public. And again, this is about that KWEB being the transmission engine for domestic consumption in China, where 25% of retail sales happens online versus just holding a lot of these traditional Chinese in it. It's all banks and energy companies. It's never going to do well. Kind of like Chile. Chile's up 68% over 15 years. So that was the purpose of KWEB, relative to the other Chinese benchmarks and China's exposure in broader EM.
So what's the current status? You got how many holdings in this? Are they equal weighted? Is it market cap weighted? What do you guys do? Do you add new IPOs? Is it actively managed? All that good stuff.
Yeah, we don't pat ourselves on our back, but we knew Alibaba was going to go public. And I, at the time, Russell indices rebalanced annually. So I was like, what if it goes public on June 2nd? You got to wait another year. So we did a fast track inclusion. IPOs at 10 billion and above go in within 10 trading days. So we were literally one of the first, maybe outside of the IPO ETF, the first ETF to hold Alibaba. We did a subsector approach that our thesis was, and this was back when, before they reclassified sectors, it was like, you got to take a subsector approach because companies might be considered tech or discretionary or today even communication. So we said, take a bottom-up approach from subsectors like e-commerce, mobile payments. And today that's a little bit of a mess because just Amazon is now consumer discretionary. Tesla is consumer discretionary. Facebook is communication. Part of what became tech got moved around, but we were unaffected by any of this because of this bottom-up subsector approach. It is market cap weighted, but in order to ensure that we adhere to U.S. mutual fund diversification rules, we do cap the biggest name, 10, 9, 8, 7, 6. Very similar to what XLE does because ExxonMobil, Chevron, Texaco, such a big weight. So we do some capping just to make sure we adhere.
Again, listeners, we'll point to the show note for links on some of these charts. But speaking specifically to this opportunity, we have some value-based shareholder yield funds that look for cheap stocks that are either distributing through dividends or buybacks. And increasingly, over the past couple of years, China keeps getting bigger and bigger in the screens. Now, going down 50% always helps in any market on the PE ratio, but on the governance side, on the cash flow, you still have to have the cash to be able to distribute it. So I think everyone understands China stocks are cheap. I don't know that they understand sort of the latter part. And you guys have some charts. One, and this is specific to KWEB, about the amount of cash on their balance sheets of the underlying companies being more than Amazon and Alphabet combined, which is pretty astonishing. But also the trend in buybacks, which have really started to ramp up quite a bit in the past, let's call it 4 to 6 years. Any thoughts on those trends or comments on that shift?
To me, it reminds me a lot of what is the recipe for a bull market. And we look at Japan, what's happened over the last few years. You had the government going in and buying. The BOJ owns the Japanese ETF market. And because China doesn't have circuit breakers, the government's actually going in and buying ETFs listed in China that they want to try to stabilize the market after this derivative-induced liquidation event. And then you have this buyback where all of the companies within KWEB, almost across the board, you had the founder as the CEO. And that founder is saying the stock market isn't properly valuing my stock, which my wealth is tied into. And they're buying back stock. Just hand over fist. Alibaba bought something like 5% of their shares outstanding in the year ended the last quarter. Tencent's going to spend, I think they upped their buyback from 10 to 15 billion. This little company, Quashu, they bought 35 million shares in the last quarter. And I would agree, the value is not necessarily a catalyst. And I think investors, the key is this unwind in terms of China exposure. I think it went through a geographic trend. It was US because of Trump, trade war, COVID. You then had a lot of European investors came down because of Ukraine and Russia, where they were very overweight Russian equities. In Asia, because visually China looked normal because of its importance geographically, they stayed in and kept getting hurt on the way down. And lastly, the Chinese capitulated. And the rewind is happening where the Chinese are buying Chinese stocks. Chinese in China have put almost 32 billion into Hong Kong stocks year to date versus 40 billion in all of last year. So you have the companies buying back stock hand over fist. You then have Chinese investors in China saying, oh my gosh, these stocks in KWEB and in Hong Kong are so cheap, buy them. And then I think in Asia, you're starting to see a little bit of these overweights to India and Japan. That's my counsel is like, listen, I can't predict the future, but I'm like, why wouldn't you take just a piece of that India or Japan or even US tech, incredible outperformance, take a piece of those profits and put it in cheap China. Your downside, now you're getting a dividend. You're going to get this buyback benefit. And then I think you can get some upside because of the improving fundamentals driven by China's economy. Like, why wouldn't you just take a piece? I'm not saying you sell everything, but I think this rewind is happening.
Well, it's interesting to see. You mentioned India for, I don't know, 20 plus years. China and India have sort of moved together. And then all of a sudden, India, for whatever reason, has had this breakout moment like countries do. There's always something going up and down. But it seems to be the biggest gap between valuations in Chinese and Indian companies, as well as trailing performance. Will be interesting to see how that resolves if it does. You mentioned it, not me, so we'll touch on it. You got an election coming up here in the US in the fall. How does China view it? Do they view it? Do they care? They prefer Trump? They don't care? They're just like both these guys rolled, whatever.
Yeah, my sense from being in China, they're pretty indifferent. That Biden has been tough on China, no different than Trump. I do think they would lean Trump, which sounds contrarian, that the view is Trump is a business person, that threats of tariffs, if you think Trump's going to put through 60% tariffs, sell your Amazon and Walmart and Home Depot and Costco because they are in big trouble. China doesn't pay the tariffs. That's part of the inflationary problem in the US, I think. And small element is that these tariffs get passed on to consumers in the US. But I think the view is like, listen, the Trump 60% tariff, that's a negotiating tactic. And Trump did a deal. It got derailed by COVID. And after he lost the election was when obviously blamed that on COVID in China. But prior, he had a lot of bark, but not a lot of bite when it came to China. Trump is viewed as someone who's anti-war, that, to do business, you can't be at war. And that led to some strange bedfellows. So I actually think they would lean Trump. At the same time, you could say, hey, listen, Biden, he's in his second term. He can back off this. He doesn't have to worry about giving an opening to the Republicans. He can do his own deal with China. Maybe that's the case.
To my knowledge, you guys don't run these currency hedged at all or have currency hedged funds. Any view on what's going on with the currency at all, or any house views on what might be in store?
Currency hedging's really hard. My little joke is if U.S. equities robbed the bank, the U.S. dollar was driving the getaway car, that U.S. equities wake up every year with a 3% head start versus their non-U.S. equivalents. That since April of 2011, the U.S. dollar index is up 40%. The U.S. dollar has beaten every currency in the world over the last 10 years. So, we're not rooting for the dollar to decline, obviously, but we do think interest rates are really low in China. A 10-year treasury in China is like 2.37%. It's cheaper to hedge today, but historically, it's been more expensive. So we don't hedge because we don't think there's a lot of risk. Deappreciating their currency deliberately would only hurt consumer confidence, domestic consumption in China. So we've not hedged. We actually think there's a lot less risk in the renminbi. The renminbi has such low vol just because their interest rates are so low. And so it's an interesting dynamic there that China's currency and bond market looks more like a developed market than an emerging market.
You guys got a couple dozen funds. KWEB's obviously the big dude. Are there any other funds either under the Chinese umbrella or elsewhere in the lineup that you think are particularly interesting, worth talking about, the strategies?
Yeah, these are like my kids. So it's
you can talk about a couple of them. So don't feel...
We got into this China business, but it's not anyone's job to defend something that is at times, if not indefensible, but are just... So, we have an EM version of KWEB called KEMQ. I'm like, listen, don't get in a fight with your clients or just hide the KWEB position. Just own KEMQ. Will it ever go up as KWEB, as much as KWEB? No, because it's more diversified. It's kind of like that EM growth factor. The fund that I think is kind of interesting is, and yes, Chinese equities have been eviscerated. On that, Alibaba's stock has underperformed its dollar bond by 70% over the last 3 years. But at the same time, what's happened in real estate and this is kind of like an indexer's perspective, is JP Morgan has an Asia US dollar high yield bond index it's called JACI is what, the kind of acronym. 5 years ago, 3 years ago, it was 50% China, 25% Chinese real estate developers. Those Chinese real estate developers, their bonds just wiped out. I mean, just gone. And in Asia, we call it Asia high yield. In Asia, they just call it a high yield bond fund. It's dollar denominated, so no currency. And mutual fund families have just liquidated those funds. It's like, oh my God. So one of your original points, Mev, like yourself, when you see something that just is debt, you couldn't give shares away. We have this Asia high yield bond fund. It's dollar bonds. And because of what's happened in real estate, those real estate bonds are all out of the index. And yet it's yielding 3 times the US high yield bond market.
Which fund is that?
So it's called KWEB. It's a Asia high yield bond. And I think you might be able to get an equity-like return out of a bond fund. And if not, well, you might clip a 15% coupon. And I'm not saying it's the solution to any fixed income investor. I mean, maybe it comes out of your equity allocation, but a small piece of KWEB can really affect an income portfolio because its yield is just so much higher. I think that's kind of a great little fund and it's under people's radar.
Well, what do you think is something when you talk about China, either it could be a statistic or just something that surprises people? When I talk to people, I have a lot of unpopular tweets, but one in particular, anytime I mention emerging markets, but when I mention, I was like, guess what you think emerging markets are as a percentage of world GDP? And people are usually like, I don't know, 20%. And you're like, no, it's over half, right? And like it's the majority of world GDP. Things like that helps frame some of these things. Are there like the cash balance? I thought was one of those you look at and you're like, wow, that really shows the scale and magnitude of what's going on here. Are there any other examples of this or ideas that when you have conversations, there's a disconnect between what people believe or guess to be true and the way you guys think about it or the way you might think about it as a shareholder?
In finance, we're supposed to be data driven. And a lot of times we're emotional or it's a political. And that's part of the China last night, a data driven perspective and look at the data. And ultimately, I would go back to there's 4 billion people in Asia. But the stat that I would want to get out there, via your audience, one perspective on China that's kind of is the Chinese don't think they have a trade deficit with the US. And you'd say, how is that possible? We import 500 billion of their stuff, and the US, we only export maybe like 150, 180 billion to them. But this is what's interesting. Why the Chinese don't believe that is the US definition of an export is solely something put on a boat. But think about Tesla's factory in Shanghai. It's cranking out Teslas that are sold domestically, and all that revenue goes to Austin now. No different than, say, Apple. Apple sells 16% of their revenue comes out of China, but that iPhone sold in China is manufactured in China. So all that revenue goes back to Cupertino. So it doesn't show up as an US export. So the Chinese look at the view of, well, you have these US run factories in China that sell to China, and some of that actually goes to broader Asia. And if you take the revenue of US multinationals who manufacture in China and sell in China, it's almost 300 billion. And then guess what? There is no trade deficit. To me, it's such an interesting dynamic of how two different people can look at the same issue and come up with two very different answers. But in China, they don't think they have a trade deficit. Even though all that money comes back here to the US as profits, it does not end up in any trade data.
I feel obliged to ask about TikTok. Any resolution on how that's going to play out with our various politicians and powers that be?
This is round 3. And so the previous attempts to remove TikTok. And I would just say, as a parent, I hate all social media. I think it's terrible. Actually, I think what Florida's done is actually a rational way. But I don't think efforts to eliminate TikTok will be successful simply because of the First Amendment. At the same time, this is where a narrative is not necessarily data-driven. ByteDance, the parent of TikTok, is owned by Americans. I mean, literally, TikTok is an American entity. 3 out of the 5 board members of ByteDance are U.S. citizens. If you look at the ownership structure, it's not exactly public, but every funding round for TikTok was from U.S. private equity. Here's the U.S. government, A, is trying to kill a company for political reasons, and I think that's a slippery slope. But 2, do these politicians know who do U.S. private equity firms invest for? It's your alma mater. It's pension funds. It's foundations. And what happens when you find out you made TikTok a zero and all these college endowments just lost tens or hundreds of millions of dollars? Politically, how can you not know that? How could you not have done that homework? It's a little bit, it's just a little bit of this political narrative. There's no speed checks, and the media doesn't fact check. I mean, have you read anything about TikTok and the US owners? And I don't mean there's one guy that, yes, he's a big Trump supporter and oh, that's where Trump, but look at the other owners. It's all US private equity firms. You're trying to make that a zero to them? Where's the media to fact check some of this? It's very disconcerting.
You guys have some good tickers. What's your favorite?
I mean, KWEB, I thought Bud Carbon.
KRBN listeners, I like CLIP, KLIP, because it's the Internet Covered Call Fund. Get it, y'all? Clip your, yeah.
It's writing call. I mean, actually, cars. I mean, I'm pretty sure it's the first EV. It's a global EV fund. So cars, this is where John Crane's last name ending in a K benefited us in other ways. Cars is probably one that, and part of that was just John and I did a meeting. And this was June of 2017. I was in Beijing. And we got back to the JW Marriott and we went for a walk. And first we went by an Apple store. And then when you come with us, and I definitely will drag you there, Meb, but we walked by an Apple store and then we walked by Tesla, a Tesla dealership. And it was interesting because at that time, Tesla was very controversial. You're like, China wants to address its pollution problem. Tesla's going to do really well here. And that we kind of said, oh, it's not just a China thing. This is a global thing. That's why we listed cars. I think it's 7 years now. It's just from seeing a great US company in China. I should have bought the stock. That was at $60 back then. So I guess we have a good cost basis for the ETF.
You look back on your career, you started out at some old school ETF shops. But as you think of your most memorable investment, because of our topic today, I'm going to let you answer this question 2 ways. One, you can answer, or both. You can answer what's your most memorable investment, or what's your most memorable experience from all your years traveling in China. It can be either one.
Charlie Munger passed away not too long ago, and Charlie Munger and Berkshire Hathaway and Warren Buffett, they made this investment back in 2008 in a Chinese cell phone battery maker that the CEO and founder said, I'm going to build cars. I'm a big supplier to Nokia, but this battery, I think I can put it in a car. His own board tried to fire him. And when Berkshire filed that they own this company, BYD, Build Your Dreams, the stock went up and then it went right back down. And literally the stock did nothing for 9 years. I mean, from 2008, 2009 up until 2018, BYD was flat. And I think about as an investor, this is the 60 quarters of opening your client statement being like, diversification doesn't work. Harry Markowitz has truly passed away. And Charlie Munger and Warren Buffett are probably the only two investors alive, unfortunately, that could weather or have a 10-year wait period. And BYD went up in 2018 alone, it went up 250%. When people discovered Tesla, then they're like, oh my God, there's this BYD company sells multitudes more. And I think that's something I remind myself is like, I got to muster my inner Charlie and inner Warren just investing in a market like China, that I got to have a long-term picture, and things are volatile in EM. That's why you got to volatility adjust things. But I think we'll be rewarded for it. I really do believe that. And I have a large position personally in KWEB. I'm down a lot. I dollar cost averaged the whole way down, but I think I'll make money. I think I'll be positive.
You hear so much of the commentary for financial media say something like, hey, the market's having a terrible year if the market was down, say, 20% or something. And you got to kind of asterisk that, because for young people, market's having an amazing year if it's down 20. It's down 50. That's like the best year ever, because you're investing for the long term and a claim on all future cash flows. Best thing could happen if something goes down a lot. It's hard for people to think that way. It goes against every single bit of emotional fortitude, and couple that with envy when everyone else around you is doing well in SPY. It creates a setup that I love and I think is great, but I think for a lot of people it's tough. As we look at on the horizon, 2024, we turn the page, 2025, 2026, KraneShares, you guys got any plans, any ideas, anything you're working on, anything you're excited about?
We tend just to keep our head down, just focus on our research. KWEB, from an industry perspective, very successful ETF, but I think the most important thing we do is this balanced, data-driven perspective on China. And we endeavor to earn the trust of investors, that if we can help them make a decision around China and we talk people down, you got to volatility adjust this. Hopefully that's kind of the biggest thing I'm really focused on. I think there's a lot of good things happening. You probably look at the GMO 7-year forecasts, and it's so skewed to non-US and international and EM. And I think we're really well positioned. And I think we all have home bias. We all have pride. I have a big position in SPY, but at the same time, if it was 2009, you'd be puking up your SPY. 10 years of negative returns, 250% drawdowns. And I hope you're right. Hopefully 2022 was the start of where non-US equities and diversification comes back into vogue. And I think a lot of investors are not well positioned if the next decade doesn't look like the last. And hopefully great research you and your team produce, and things that we're trying to do help people adhere to modern portfolio theory and diversification, because this too shall pass.
Well said. Where's the best place to find what's going on with you guys and all your writings and research?
Just KraneShares.com.
Easy. Brendan, thanks so much for joining us today.
No, thank you for the opportunity. It's great to connect, Meb.